is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me is Chad Huebsch. So, most of you probably follow me on Twitter, which means you probably see Chad and I engage. He's a really good tax advisor and tax filer. I think I like to distinguish between the two because, Chad, I'm sure you can talk about this, but like 99% of the people that come into work with me only have tax filers on their team. And, for us, we do a lot of the tax planning, but there's also a lot of people who don't need an ongoing financial advisor, but still do need a tax advisor. So Chad's one of the better ones in the industry who, the more that I've learned about you, the more that I realize we do a lot of the things the same. We're doing a lot of the tax planning meetings similar times per year. We're going over the same things. And, I think that shows a lot because I built it this way simply because I'm like, nobody's really doing this. And so I love that you're one of the, tax advisors on the forefront of the industry saying, hey, I actually can sell tax planning, because that's the biggest excuse that I'm sure you hear, but I hear too, is like, I want to do tax planning, but I can't get anybody to want to pay for it. And I'm like, I just don't feel like that's what I'm seeing or what is true.
No, people are begging for it, and more so than employees, like business owners. Well, even employees with like equity compensation.
Yeah. Executives,
Yeah.
equity comp, like they want it. The other ones, it's just kind of withholding unless you have like large portfolios or
Right.
something. But it is like, that's what I'm saying is like everybody that reaches out, their number one pain point has to do with taxes and tax
hmm
planning.
Yeah. And just like, hey, my only interaction with my accountant is like, give me your stuff, and then I don't hear from them until they tell me I owe this big bill, and then yeah. Well, so let's flip it on its head. Let's start with planning and end with filing, and not
Yep.
the other way around.
Yeah, the biggest misconception that I see all the time from people is, hey, like, I think my tax person's pretty good. Like they make sure my tax bill is as low as possible. And I'm like, when you hand them the documents, the tax planning was over. Like
Yeah.
all the moves you should have made happen intra year. Sure, like you can maybe round up your HSA or do your backdoor Roth or a few things
hmm
like that, but they didn't really advise you on that. You still have the time to do it. Like you're not going to hire somebody because that person versus you is going to get you a lower bill. It's just filing, right? They're just taking documents and putting it into the right spot. That's not how you reduce your taxes. But
No.
that moves us right to our conversation today on taxes, how to reduce your taxes, and basically most common tax strategies for 1 to 10 million business owners.
Yeah. No, that sounds great. There's four big ones that I start with, and each
Okay.
one could probably be its own topic. So I'll keep it as surface level as possible, but feel free to dive in with
Yeah,
questions.
let's just go one by one and then I'll kind of chime in as we go.
Perfect. So first one that I always look at is entity selection. So how is the business organized, and is it organized formally at all? So the first one would just be a proprietorship, sole prop, disregarded. There's no formal LLC or corporation set up with the state. And that is taxed, I would say, the simplest, whereas there's no separate tax filing. It's filed on your personal return, it's filed on Schedule C. All of the income is subject to self-employment tax, 15.3% on up to, it's about 170. It's going to be creeping up again. Um, and then obviously state and federal income tax.
Yeah.
Yeah, go ahead.
I was just you can do the whole entity and then I'm just going to chime in before we move to the next entity.
Okay. So yeah, sole props are simple, straightforward. They're usually really helpful if you have a really high paying job elsewhere and you're just wanting to get something set up on the side as a side gig or otherwise. So that's sole prop.
Yeah, I feel like I almost never see a sole prop end up making sense. Like, and maybe sometimes you'll be an LLC tax as a sole prop just
Yeah.
because you're like, whatever, but at least you get the LLC wrapper. But in general, right, like you're getting no PTET. So
hmm
that's always going to be one downside there. You're going to have
Yep.
self employment taxes on the whole amount. If you are, let's say you use the example of a high W 2, sure, then that's not going to be as big of a hit. But the last thing that is I found to be true and what I've heard from auditors is that your audit risk is like 10 times higher as a sole prop than any other entity because it's just everything's murky, right? And so like sometimes I'll have somebody come into me and they'll be like making $1 million a year as an LLC tax as a sole prop, and we're kind of like, let's move this, let's treat this a little bit more like a business than what you're doing now. I think we have to talk about it, but
Yeah.
I feel like if most people the sole prop is kind of like you haven't done any planning at this point.
Basic, it's just proof of concept. But yes, most people will move into an LLC. Like you said, it's a good wrapper. Um, and then The next one that we normally like people graduate to, depending on their type of business, is an S corporation. And I'll say that S corporation is definitely overused generally, but there's a place for them, and a majority of my clients who are in the 1 to 10 million range of revenue operate that way. Um, I would say it's most beneficial for those cash cows. It's service-based businesses generating income where you're not going to be expecting big losses that you're going to need to have pass through. The change is actually fairly straightforward. So your LLC, in most cases, some states like California, usually it's a corporation that you set up legally and then elect into an S corp. But most states, you set up an LLC, you file a form with the IRS that, for tax purposes, changes the filing from what was a Schedule C to
Takes
now.
2 seconds.
Yeah, now is a 1120S is the form, but it's an S corporation tax return. The real main benefit, there's a couple, but the biggest one is the self-employment tax savings, which means you put yourself on salary, and whatever the salary you pay that 15.3% payroll tax, self-employment tax. Those two are synonymous. Everything else is distributions is not subject to it. The IRS does put out some language around what your salary should be. It says it needs to be reasonable, but they don't. There's no bright line test, so there's um, some area to work in there and to
Yeah,
capitalize on
it's
savings.
a hard one because you can find like conflicting evidence on everything, right? Like you'll find in California, the average in this role could be anything from like 100 to $500,000.
Right.
And I'm curious to hear your thought. Like when I talk to a lot of CPAs or a lot of CPAs who were, or EAs, not
Yeah,
distinguishing,
you're
but
good.
or EAs who were, worked with the IRS, what always I hear is just if they're really high income, cross the Social Security wage base. Like I'm not stamping that advice by any means, but you're like, if you're making $1 million and you're paying above the Social Security wage base, hard to argue. I think the issue comes in when people are making 300K, 400K, 500K, but they pay themselves 20K or 30K or 50K, right? Like
Exactly.
that's the
Yeah.
issue. But like the taxes are not very different. You're still paying state and fed. You're
Hmm.
still capping out, Social Security. Sure, you might have a little bit less on Medicare, but are people coming after you because you had 300K less by 2.9%? That's half deductible. Like, I don't know.
Not usually, not what I've seen. I use a formal software that's out there on the market. It's called Reasonable Compensation Reports or
Yep.
RC reports. It's really good. One of the methods that they look at is the many hats approach, which basically says, as a business owner, you're not just, let's say you're an attorney. You're not just an attorney. You're doing HR, you're doing bookkeeping, you're doing bill pay, you're doing all this other stuff. Um, and so that usually can come up with a defensible position, but lower than potentially like a market rate.
Yeah.
I was going to say salary is another big component when you talk about these entities with S Corp or even C Corp to a degree. But with an S Corp, it affects how much you can contribute to a profit share on a 401k, which is another planning opportunity, as well as your QBI deduction. It could be
Yeah.
limited because of the low salary.
Yeah, and I think, S corps have a good rap and a bad rap, right? Like think there's some because like the average business obviously if you look averages probably doesn't make a lot of money, but the average business is still advised to be an S corp. If you make 50K, an S corp doesn't make sense. Like in my mind, I really don't consider S corp until above 200,000 in profit because I think at the earlier amount, especially if there's no data to say like this is your first year of making 100K, it's like is it really worth a 50K salary, 50K profit so you avoid yes, like let's call it 7,000 of self-employment taxes, but then you can't do any profit share. QBID now is 10K versus 20K, right? Like after
Hmm.
all of it, including added fees, if you come out 1,000 ahead, that's just not a needle mover. Because what if the next year you make 70, and now you're like,
Exactly.
oh, I've already have this reasonable salary. There's barely any benefit, et cetera. So like I think they're oversold, but they're also extremely beneficial. I see other tax professionals online acting like S corps are terrible, and
Right.
I don't think that's true, right? Like if you're a very high profit business that is QBID eligible above the threshold, you
Hmm.
need it, right? Unless
Yeah.
you're very wage heavy, maybe you don't have any wages,
Hmm.
you're going to need it to get the qualified business income deduction. So I think maybe if you have real estate, again, if you want carry forward, if you're going to, one step up in cost basis, things like that, there's some downsides to it. But in general, high profit businesses, pretty good tool.
Yeah. And one last thing about reasonable comp, because it is talked about a lot, but I did recently go help a client through an audit. It was an S corporation solely owned by one individual. The salary that he had been paying himself was only 50,000 a year, and in the years that he was chosen for audit, his income, his profitability increased significantly. There were several things that the auditor wanted to change, but the compensation wasn't one of them. So I thought that was an interesting data
Really
point at 50K that wasn't adjusted.
interesting. Yeah, that's pretty surprising. But I mean, I think S corps good benefit again. Now, if you move from sole prop to this, now you also have PTET ability, so
Yep.
paying those state taxes through the business. But then again, you're right. Like if you have a low salary, you can only do the 23.5 plus 25% of W-2 wages. And
Right.
then I guess you get the rest in via mega backdoor, which is
Yeah.
fine depending on your tax rate. But
Mhm.
I think that's something that people don't always think about.
No. So S corp is fairly common for small businesses. The next one that I generally see more often is partnerships. So that in most cases there's an LLC taxed as a partnership, which really just means there's more than two owners or two or more owners of
Yep.
that entity. Partnerships are great because they're flexibility in allowing contributions, distributions, etc. It also allows you to take losses a lot more easily than an S corp. Certainly, it can get locked up, or you'll have excess distributions on the S corp side. But for anything with debt related, a partnership tax designation is usually very beneficial. With an S corp, let's say you have 50-50 owners, the distributions have to be 50-50, and the only way to modulate how you pay yourself is through salary, which kind of goes against one of the core components of even owning an S corp is increasing your salary. So
I'm really glad you brought that up because that's one thing I think people forget. They're like, okay, I'm going to move to S corp, but now I'm going to have to pay equal distributions. But like, I have some clients who they don't want that, right? They're like, well, we want to bring it in based on what we bring in, and so then you're like, well, if you're both really in similar roles, like, can you change your salaries? Probably because you're like, hey, I'm bonusing myself from
yeah,
what has been brought in. But if you want like any customization on distributions or like one partner is way less involved, it becomes a lot messier.
yeah. So for like a lot of professional service companies, if the states allow it, so they'll have the operating company be a partnership, and then each owner owns through via an S corp. So partnership
That's
pays the
what I
S
have
corp.
not talked about. And it's so common, right? It's like
It
one of the
is
best moves that you can make, right? Is okay, partnership, separate LLCs up here. Those LLCs can have solo 401ks. Those
Mhm.
ones can, you could be an S Corp because sometimes you'll have like two business owners and one's in California and one's in New York, right? So
Right,
PTET is weird. But on top of that, California might want an S Corp and they might live in New York City and they might not.
right.
And so like I think that's one of the holy grails of tax planning that I found with multiple partners that very rarely do I see people actually put in force on their own or be advised on.
Yeah. Yeah, there's a lot, and this is really entity selection, right? There's so much you can choose from depending on your facts and circumstances. So to say like you have to do an S corp or avoid it at all costs is really short-sighted because there's so much
I also think
nuance.
this is where people are like, how come you haven't gotten like everything done, our whole tax plan, like everything in force in like 2 months? And you're like, I don't
Right.
think you realize how complex all of these decisions are and how much you want to like, cross your T's, dot your I's before making that decision because certain ones are not easy to move away from or
Yeah,
to.
exactly. And S corp, if you're like, nope, don't want to do it, you can revoke its status, but then you're stuck with whatever you're left with for the next 5 years. You can't re-elect, and there's usually like some taxable event by revoking your S corp status as well. So you can get locked
Not
in
ideal.
pretty easily. The last one I'll mention is just a C corp or a traditional corporation. You can have an LLC be taxed as a C corp as well. It's usually most favorable, and I see it in like the tech space as well as businesses that are wanting to raise capital. C corps are
Yep.
usually the best way to do it.
Yeah, I find C corps to be the best for raising capital especially because you get the multiple different types of shares, which
Yep.
are good. If you have QSBS eligibility, if
Hmm.
you're just really heavily investing in your business, if you're like, hey, I know I have like a 10-year growth plan of like, I'm not
Yeah.
taking money out of this business. Well, the double taxation's lower, right? Because you don't have the double part. You just have that 21% corporate tax rate
Yep.
versus, I've been advising other people who are like, we might be profiting a couple $1 million, but we know we're going to want to reinvest, 1.8 of that back into the business. And so it'd be much better to stay in this C Corp wrapper and not have to pay that added tax, rebuild it back in, et cetera. But like, I don't find service businesses to be good there. Sometimes you might have like
Hmm.
businesses that are like heavy machinery
Yeah.
or, you know, different things like that. But
It's
um,
it's not common. I used to work for a firm that does a lot of dental offices, and some of the more old school, getting ready to retire, were set up as C corps because that's all they had back in the 70s, 80s, 90s
interesting.
to do
Probably
that.
not the best one to be, but I mean, I guess you're not
Right.
giving up QBID most likely in an S Corp, but
Right. Right.
interesting. Okay. I
So,
think before we move to the next one, I think like so much of tax planning lies into this first part. Like I think people brush over it like this is an easy decision or that it's simple, but like I have clients, the difference between a sole prop and moving to an S corp is literally like 200K in tax difference between getting QBID, optimizing that, and PTET. Like those two alone in certain states are just like incredibly impactful, and it doesn't look like from the new tax bills that either of those are going to go away.
no. And in fact, the one about the PTET being reduced by 50% for some of the service-based businesses, it didn't make it out of it did make it out of the Senate. Like it's not in that version. So I think we're safe.
Yeah,
Um,
yeah,
Speaking of PTET, that's the number two is what I would go to, is that it's such a big benefit. And what the PTET is that right now under current law is that you can only deduct up to $10,000 of state and local taxes, which include property taxes as well as state income taxes on as an itemized deduction. It's been that way since 2018. Has been a huge hamper on high earners and people in higher taxed states. The PTET is basically if you have a pass-through entity, which we just talked about two of them, S corporation or partnership, they can elect to pay the tax at the entity level on your business income, and then you get a credit for it on your personal return. The reason why the business pays it is that it reduces the federal taxable income in the year that you pay it. So
yeah.
you it's just a convoluted way of getting the same benefit, but you gotta jump through the hoops.
Yeah, it's one of those things that like you definitely are not doing good planning if you have the ability to do this and you're not doing it because you're not giving anything up by doing it
Mm-mm.
unless somehow like you're one of the states that's not refundable and you overpay or something. But in
Right.
general, right, like you can deduct 10,000 of state and local taxes. That's it. If you're in California, like my clients in California, New York, et cetera, their tax liabilities of the state are six figures. So
Yeah.
you're leaving all this on the table. So
Mm.
PTED says, I'm going to pay the state taxes attributed to this business through the business. Then that's going to go save me federally. If that's 100K, right? That's, the difference of a $37,000 tax savings at the federal level. But you just need to make sure you have an entity that allows, like you said, partnership or S corp. Sole prop isn't, C corp is not. But then you also have to be aware of the dates. You have to elect into it. You
Yep.
have to make the payments at the right time, and not miss it. But it's weird. Every state is different, right? Like, New York might have 4 times a year. California is like 615 and then 315. Like, you
Hmm.
really do need to be aware of it. And you'll even see like lawyers, right? Lawyers will have like 8 states of PTET on their
Yeah.
like pay stubs, even though they're not technically pay stubs. But PTET can get pretty complex fast, but incredibly impactful.
Super beneficial, and because there's about a 2.5 year gap depending on your state between 2018 and 2020 when they even allowed PTET. Before
Yep.
then, you were just like, we're stuck at 10 grand.
Yeah. And to me, it's like kind of a crazy tax law that like you have an advantage by living in a high tax state. Like when in reality, I would have much rather them made QBID for everybody and not limit SSTBs, but then keep
You're,
PTET.
you're speaking logically, so you got to stop that when we talk about taxes. The last thing that I'll mention about PTET, and it's not a state where there's big population, but as a unique how it works is Utah. So Utah, it's usually based, PTE laws by state are usually based off of the net income of the business. Well, in Utah, you can actually overpay your PTET. It's not a calculation So let's say your normal tax based off just the business income is 100,000. Well, let's say you have W-2s and other sources of income, you can reduce the withholding or on the pay stub, or and
Yeah.
not make state estimates. You could just increase your PTET deduction at the entity level, and there's no cap. So it's pretty unique finding
So you're like,
opportunities.
hey, I'm a lawyer making $1 million. I have a business that makes 50K. I'm going to pay like 50K of PTET right through that business,
Yeah,
offset it there, get the whole amount. That's crazy. I didn't
it,
even know that.
yeah. Utah's very unique in regard. Most aren't set up that way,
That's
um,
crazy.
and it
Cool.
seems
What's
like
the next one?
yeah, PTET's not going away. It's going to stick around
I'm
next round.
shocked by it.
The next one that I really like, and again, we just talked about there's limits on it that we really good tax policy would be no limits is the QBI or the qualified business income deduction. So at a high level, if you run a business, and most in my experience, most rentals also apply to for that, is it's 20% of whatever your net business income is, you get a deduction on your personal return. Um, that's only applicable if you file as a single person up to 191,000, and for married filing jointly it's 383. Anything above that it starts phasing out. And so below those figures you can count on the 20%, but then above those figures it actually becomes less of a function of the net profit or the net business income and more of how much wages you pay and how much assets you own.
It gets complex. It gets
Yeah.
complex fast. And this is where we were talking about the entity election. Like when we think about entity election, it's not just pick the entity, it's pick the entity based on all of these next variables like PTET, right? Now,
Exactly.
like QBID, because if you're the business that makes 200K and you say S Corp or 150K, you say S Corp, now you move the salary, now you're hurting QBID because you get profits. On the flip side, if you stay as an LLC, but you're making 700,000 and you're QBID eligible and you don't have wages, now you get $0 wages there. But then, there's the whole side of us, right? If you're a lawyer, doctor, financial advisor,
Hmm.
CPA, et cetera, above 483, you don't get the deduction at all. So now
No.
S Corp, versus that might purely be self-employment tax savings, right? If you're making a million, or
Sure.
I have clients making 2, 3, 4 million,
Hmm.
300,000 of wages, 2 million in profit. 2 million of profit still by 3% is almost 60K of tax savings by
Yeah.
being an S corp versus not. Like it's incredibly impactful. And some tax people try to argue that you can't plan around QBID, that it's actually not lawful. And I'm like, I don't know if that's really true. Like you could give
Yeah.
out more bonuses to employees, or like instead of that and you want to reduce profit, you can do profit shares to 401k versus bonuses because that helps QBID, or you can pay yourself a bonus because the business year ended up better. I think there's a lot of good ways to plan around QBID.
For sure. And my clients that so most of my clients we meet with twice a year, once in the summer and once in the fall. And in that fall meeting, we're all double checking their QBI deduction, where it's projected to be, and where in the phase out they are, so that if we need to give them a 10, 20, $50,000 bonus at the end of the year via W-2, in most cases it pencils out even with the additional payroll taxes, you're saving more on QBID.
Yep,
Um,
exactly.
I had one specific example on this. So I had a client recently met with. They're an attorney, so they're subject to the limitation. Once they're over 383, they don't get any QBID deduction. Um, he wasn't fully participating in the 401k. So if he were to max that out, which he's done about three, if he does the remaining 20,000, the eligibility for QBID plus just the tax deduction, because it's a pre-tax 401k contribution, it's actually at 50%. And he's in Arizona, so you're paying 39% in Arizona. I know California you can get above 50, but basically it's a 50% break on the 20k he puts in. He's going to get a $10,000 tax deduction
Yeah,
because
I
of the
mean that's where
QBIs.
planning become impactful. Imagine you're at 500, you have this dual business, you can max both solos, or even think about cash
Hmm.
balance plan or certain things to be like, I move from there to now, if I can drop it down by 100, then I also pick up another $80,000 deduction. Like, I mean, you could just do so much cool tax planning by knowing where those are and how to get you to that spot.
Yeah, and one nice thing, because technically QBI was scheduled to phase out this year. Like this was the last year for QBI, but in both versions of the bill, it stays. So we're looking forward to that additional deduction. Um,
Love it.
so we talked about entity selection, we talked about PTET, we talked about QBI. The fourth biggest one, because there's others, but the fourth biggest one is retirement planning, what options there are available. Um, the biggest one, especially if you have any sort of dollar amount to put into it, is just setting up a 401k. And that's a solo if you don't have any employees, or a traditional 401k if you do have employees. Um, the max is 23.5 for 2025. You could do up to 70 with the profit share, or you could do like the mega backdoor Roth conversion by putting in after tax money there. But it comes back to entity selection as well. So with a C corp or an S corp, the profit share is limited to 25% of your W-2. So you got to plan for that. If you're really wanting to put lots of money towards retirement early on, you're going to need to have higher wages to be able to support
184.
that.
I know that number because that number is used a lot with the clients that we have.
Yep.
And so, but if you do less, right, maybe early on and you do 100, you can still get in then 23.5, 25 on the profit share, and
Yep.
then all the way up to the 70 from the mega backdoor.
Yep.
So I think that one's really important. No, and if you're a partnership or sole prop, then it's going to be 20% of profits less half of self-employment
Yep.
taxes. But I mean, at the end of the day, I think of this as too many people overlook retirement plans because it's just a deferral. It's not truly a tax savings. But if you're like, it's just a deferral, I want the deferral, I can't see why you wouldn't go Roth and get tax-free growth forever if you're just
Exactly.
going to invest it elsewhere. Like super impactful. And to me, this really all comes down to solo 401k or regular 401k. I
Mhm.
rarely ever see a simple makes sense now that you can set up a 401k for the same cost. Now
Mhm.
also have backdoor Roth ability, et cetera. And SEP IRAs, I almost never see making sense either.
No, the few times that I've seen it, it's usually like used as a band-aid after the fact of, oh shoot, you didn't do any planning, so here's a SEP IRA. But again, for your wages have to be over 200K to max out the
Well, and
SEP.
solo rules now, like if you're not an S corp, you can set up your solo all the way to tax filing or extension deadline.
Yeah.
If you are, I mean, if you are an S corp, then if you do it later, then maybe, hey, last year I can't do the employee side anyway, so it's going to be the same as a SEP. So still, even then, it gets you to the same spot.
Yeah. And I think this is more of a symptom of business owners and real estate investors. That's a good chunk of our clients is real estate. Um, they don't want a tax bill, so they're going to spend their way out of it. And it's always short-sighted to be able to say, "Hey, I'm going to spend 100K to save 37K." Well, you're still out
Yeah.
the 100K.
Yeah. Here's my tweet on the G Wagon or the car or whatever from.
Yes, exactly. And I always try to point them back. You're not maxing out your 401k. This is money that you can get the deduction for this year, or if you're
You're
doing
not losing the money.
The Roth, it's going into a bucket that it's going to come back to you down the road.
Yep.
So
Yep. Exactly.
low hanging fruit. Um,
I love it.
Most clients are above the threshold to directly contribute to a Roth IRA, so they got to jump through the hoop and do a backdoor Roth. Um, most of my clients, especially the ones that are married, they employ their spouse, and really the main benefit tax wise to do that is so that they can also max out their 401k as
Of
well.
course. It's
Yeah.
that's like the easiest low hanging fruit. Most people's spouses are helping in their business in some way, right? Like,
Yes.
and you're not saying go pay them $600,000 a year. You're saying like
Mhm.
for me, I'm like you make $2 million. Can you find enough work to pay your spouse at least 30, right? Because for me,
Yeah.
at least 30 gets the max 23.5 and some profit share.
Yeah.
My holy grail is 70. Can we find a way? Can you give them enough work to do 70? If not, totally understandable. But the
Mhm.
other way that people don't think about around this is what if you just have a partnership with your spouse? Right? Like if you're
Mhm.
50-50 owner of this with your spouse, like there are partners of tons of businesses that you're a 50 partner, it's not the same amount of work for the two partners at all times, right? They're
None.
helping do work, 50% flows through to you. That opens up a lot of good planning too.
Yeah. Yeah. So it's money you're just going to come back to. So it's just put it in there. The other big one, and this is really when they are wanting and have, million, two, three, five, up to 10, is that cash balance plan or defined
Yep.
benefit. So what that is basically you're piggybacking on top of your 401k. What most people understand is like a pension. So basically,
Yep.
it takes a look at your age and how close you are to retirement and your salary, and it tells you how much you can put in. And I've seen multiple six-figure deductions into those
Two,
plans.
300K, like especially like husband, wife. Like I have a
Yeah.
client who he'll get in 280 and he's low 40s between the two of them, right? That can stack and be more. I think it's really good if you're fine with deferring more. You have so
Hmm.
much money and you have like a few years of so much money and you're like, I'm
Yeah.
never going to be in this bracket again. Deferring is so impactful. The good of it is that. The downside of it is it has to have a low growth rate. If the growth is high, then it reduces the contributions.
Hmm.
You typically have to commit to it for at least 3 years.
Yeah.
If you have employees, most times you have to contribute some for them.
Yep.
If you are doing a solo 401k or a regular 401k, your profit share goes to 6% versus 25%. But if you get an extra 200 in, but you lose 30K, that's not that big of a deal. And the other one is just the fees, right? There's an actuary, they run the plan. These are one of the things that like I think there's like solo for some of these are no brainers, and then this is the when does this great
Yeah.
tool? It's definitely doesn't make as much sense as the other ones, but when it does make sense, it's like one of the best things you can do.
Yeah. Major tax deductions if it makes sense. And like you said, you have to have multiple year horizon to be able to fund this plan, keep it open, and yeah, make sure that you have the cash to it. The last thing I'll say about that is you can turn it off and on in multiple years. And what I mean by that is you can really like, hey, this is a bigger income year. We closed a couple bigger contracts. We can make it to 300,000. Oh, next year it's not as high. We're going to keep the plan open, but maybe we only put 10K in there.
Yeah, like whatever the minimum contribution is. That's a good point. The
Exactly.
other cool thing about it is because you can fund till the tax filing deadline,
Hmm.
a lot of times what we'll do with clients is let's extend your taxes. Now we have an October deadline. We almost know this next year's income at that
Yeah.
period of time. So we have 2 of those 3 years
Hmm.
almost covered where the risk is the next year is not that good, but we also could hold extra cash. We could funnel from your taxable account. There's a bunch of good things you can do, and it gives you time to be like, I have more certainty than potentially other times.
Yeah, for sure. Those are the four big ones. There are other ones that are a little bit more ancillary. I'll start with what I view as a basic one that everyone should be doing, but most people do it wrong. And in the veil of an S corp in that realm, it's called an accountable plan, which basically means all the stuff that you typically pay for personally there's a way for the business to reimburse you for. It's not going to save you tens or hundreds of thousands of dollars. It's going to usually amount to a few thousand, but it's
Yep.
money you're already spending, so it's already in your budget. What the accountable plan covers typically is home office deduction, your cell phone, home internet, and if you don't have a business vehicle that you drive more than 50%, it helps you recoup the mileage, which is like 70
Yep.
cents a mile for 2025.
Yeah,
Um,
that's one that I feel like people just don't know about because they before were an LLC as a sole prop or a partnership, and so they just feel like they can deduct those things, and they don't realize now at the S corp you have to reimburse you set up this plan and reimburse yourself for it to
yeah.
actually do it correctly.
Yep. And for partnerships, you can do a type of accountable plan for a partnership, but most generally, I see partners deduct those things as unreimbursed partnership expenses. But your operating agreement has to allow for it. So, just a couple things
Yep,
to keep in mind there.
makes
The
sense to me.
other
I love it.
the other big one that I see a lot is paying kids. So, should I pay my kid? Is a common question that we get with our business owner clients. And the answer is maybe, as in most tax situations. Um, Paying kids can be can be very valuable in that if you're
Yep.
in 37% and they're in 0%, you can move money into their tax bracket and have it be paid at zero. The where people get into trouble is you have to make sure that it's for work actually performed. It can't just be paying them because they're your kid. They can't. It has to be like work specific for your business. You can't pay them to do chores and and write it off as wages. Um, and it has to be market rate. So you can't, if that task is $20 an hour, don't pay them $200 an hour
Yeah.
for that stuff.
Yeah,
The
this
the
is one that gets used a lot.
yeah. So especially like people try to do like, oh, my 6-month old is doing marketing expenses, so I'm going to pay them exactly the standard deduction for that year. It's like you need to do a little bit more market
Or
research.
baby modeling. They're like, yeah, we have photos on
Yes.
our website. I'm like, your baby did not at $50 an hour if you want to argue that, which is already high.
Yeah.
14 grand. Like I promise you that did not happen.
That's not happening. So even if you're not maxing it out, and if you're putting hundreds, if not thousands, a couple thousands away, that can have a huge impact, especially if you use those funds to fund a Roth IRA or a 529.
That's really the benefit at the young age. Can we get
Yeah,
any money in? Can we get any money into a Roth IRA as young as possible?
yeah,
But I tell people like you don't have an excuse now. Like there's just no reason your kid is too young. Overfund your 529 for those
yep,
young years. And
yep.
then once they're 12, 14, then start paying them. Let them do the Roth IRA. And it's not as good as the Roth IRA, obviously, but
But
it's better than nothing, right? Like it still can give you a
exactly,
good benefit.
exactly. Um, the strange caveat is, again, it goes back to entity selection. So if you run a sole prop or a disregarded entity, so an LLC without a tax election, paying your kids does not incur payroll taxes. So you're saving
Yep.
not only income but also payroll. With an S corp or a C corp, you are on the hook for those payroll taxes, but you do get the income tax break.
Yep. Yep.
Um, the other, I think I have just two more, maybe a little bit more, but is around real estate. And so one of the more common ones that we see with high income earners is the short-term rental loophole, but it's in the tax code. So it's section 469C2. Basically, if you have a short-term rental, it's not considered a rental, which, taking a step back further, most rental losses are passive and they cannot be used to offset your W-2 income or your active S Corp K1 income. So um, within the last 5 years, especially post pandemic and during the pandemic, a lot of people were getting in the
Airbnb,
short term
really.
rental, yep, range. And so what it allows you to do is, if you meet the requirements, which is the average length of stay is 7 days or less, no personal use, and you materially participate. This one is, there's a lot of misinformation around there. So you have to show that you meet one of the, I think it's 8 material participation tests. The easiest one is to show that during the year you spent at least 100 hours, and your 100 hours is more than anyone else's time spent on the property,
That's the
which,
big one.
yeah, which would include cleaners or property managers, etc. The other one that you could get to, especially if you have multiple, is 500 hours. So if you reached 500 hours, and even if you had someone that did it more than you could get there. But the one that people try to get their arms wrapped around is that 100-hour
Yeah.
requirement. If you meet those 3 requirements, you can buy it, do a cost segregation study, accelerate a bunch of depreciation, and since that loss is not passive, you can use it to offset your income.
Yeah,
Um,
I really like that one when it makes sense. I think
yes.
people just need to know like you're not going to live in California and own a short-term rental in Texas and pass it. Like you
Yeah.
just never are. I like it. I have some clients who do it, log your hours, make sure it works, and if you're doing it correctly, it's an amazing strategy. Same with your spouse being getting rep status. If your spouse can
Yep.
be a real estate professional, also another good one. But I think inside of real estate, the one that I think people forget about sometimes is buying the building that your business operates in,
Yep.
right? Because then it's different. You're already operating in that business. So then you can use those losses for the part that's attributable to where you operate in. So if I own a mall and I'm in one of 5 spots, a good percentage of that's not going to help. But if I own one building that I have a showroom and all this stuff, that's going to help and can be really impactful in a super high income year.
Exactly. And so it's not in those situations you need to make sure you're filing the grouping election. So it's the 1.469-4 election. And basically that says my business and my rental, this is a common economic unit, which is really just the tax law verbiage. But basically those two are not treated separately for tax purposes. And so now you can have a loss that you use to offset your business income. So it's very powerful for sure.
Love it.
Um, the other one that gets a lot of fanfare, and there was a court case, I think it's about a year old now, that really hammered someone on, was the Augusta rent strategy. So it references code section 289A-G, which basically says for your personal residence, you can rent it out up to 14 days and not pay any income tax on it. It's not treated as a rental. Where some business owners have gotten into the Augusta rent is they use it to host like a Christmas party or a summer barbecue or a quarterly meeting, and the business pays you as the owner for the rent. You get the deduction on the business P&L, and then you don't have to pick up the income as rent. The problem is that people were using outlandish dollar amounts to justify. So they're saying every day we're charging $3,000 for rent, which in some markets, maybe Malibu, that would be a good comparable. But in Texas or otherwise, you have to use a reasonable rate. So if you're going to do this strategy, document it. So like have meeting notes, put it on your calendar, because that was another thing that the IRS and the tax court dinged this partnership on. There was three partners. They each did it 14 times a year, and they each charged $3,000, even though they lived in different parts of the country. So document it, calendar, document it with meeting notes, and look at Airbnb or Vrbo and see what rental rates are going on in your neighborhood, and don't do it for 10 times that amount.
Yeah.
To do it for a
This is
reasonable
one
amount.
that I'm like, if you want to do it, do it. But you also, right, you can't be taking the home office deduction and then also be doing the Augusta rule.
I've there's some strong opinions about that. I'm in the camp that you can do both, but you can't double dip. You can't take a home
Fair.
office deduction and also use that same space. But I know
Yeah.
some tax pros that are like it's one or the other. And in
Yeah.
most cases, home office just makes more sense.
Yeah, that's my thought. This is one that like if it works, it works, but like people like bend over backwards to figure out how to be like, I had people here for 4 days at $500. I get
Yeah.
2,000. It's like
And so,
document it well, I guess, and do it by the book because it is an audited strategy, but it's one that I just think is good, but people hype on too much when there's all these other ones you mentioned are definitely more impactful.
yeah, much more low hanging fruit and higher dollar amounts you can deploy that way. So
Yep.
those are the main ones that at least we start with business owners because they can hit most of those. And there are other strategies, but that's time for another day, I suppose.
Yeah, I mean, at the end of the day, I think for planning for this 1 to 10 million revenue or profit businesses, I think it really does come down to entity election, QBID, PTET, retirement accounts, hiring spouses and children. The rest of it, and maximizing deductions, of course, the rest of it, then potentially there's like charitable giving externally.
Yep.
But then the rest of it, I think, comes down to really capital gains tax planning. So like exit strategy, those things,
Hmm.
but then also estate tax planning. But those are like, that's each one of those are a long enough topic in their own, and they're not specific to only business owners. So I think we hit on all of the top ones. So Chad, I really appreciate you coming on today. Everybody that's listening, Chad's going to be on for another episode here in the next few weeks. So make sure to tune in to both of them. But before we head out, Chad, best places to follow you.
Yep. So you can look at LinkedIn or Twitter/X. If you want to reach me directly, you can go to my website, which is bluetaxplan.com.
Love it. Love it. All right, everybody. Hopefully you're enjoying me having guests back on. I like my podcast so much more with guests. So please remember to rate, subscribe, and see you back next week.